So hi and welcome to the first time buying a home webinar speaker series. Here with Robert Weaver, Vice President of the Mortgage Division for People's Bank Mortgage. And this is Alan Donald, broker with Keller Williams Realty in Charleston, South Carolina. Welcome everyone. Today we have a little bit of an introductory webinar with reasons to buy a home, and we're going to talk a little bit about interest rates, the market, and whatnot. Hopefully we'll answer many of the questions you might have, and hopefully we can answer every question that that is asked. If you have any questions, please type it on the chat box on your side, and we'll try to address it as we go or at the end. We'll have also time for Q&A. Robert, are you there?
I'm here, Alan.
Okay, can you see the second slide already?
I can.
Okay, wonderful. So today's agenda, we're going to talk about reasons to buy a home. We're going to talk a little bit about home prices and the Charleston market. Robert's going to elaborate a little bit about interest rates and where we think they're going. And then I'm going to walk you through the buying process, and then we have some Q&A and some freebies at the end. That okay with you, Robert?
That sounds great.
Awesome. Okay, well, this is a statistic that when I looked at it, it was pretty surprising. It was a survey done by Pulte, one of the bigger builders in the U.S., and it says that 85% of millennials, people that are in the late 20s, early 30s, plan to purchase a home in the future. That's pretty high. And the interest of the millennials about buying a home has increased substantially in the past year, and so that creates a big of a pent-up demand in housing that is interesting to note if you're thinking about buying a home. So why is it that people want to buy a home? There are some reasons why people buy homes in the U.S. One of the things is financial leverage. I mean, I don't know if you can think of any other investment where you can invest a little bit of money and buy a large asset like it is a home that you can buy pretty much with, you know, in this case, 3.5% in terms of FHA loans, or even with 100% in the case of VA or USDA loans. The second reason is everyone needs to pay for a roof over their heads anyway. You need to pay for housing. Whether you rent or you buy, they're still going to have that expense. The third reason, and it's a very popular reason why people buy homes, is it forces you to save. Every month you're increasing your net worth by paying off some of that mortgage. And so that's very important if you want to accumulate wealth for your latter years. One of the other benefits that sometimes people don't know about is that there are substantial tax benefits to owning a home. All the interest that you pay to the lender at the end of the year, you can actually deduct from your taxes, and effectively lowers your tax rate. Another reason is you can hedge against inflation, because if there is inflation in the economy, normally real estate will also appreciate. So it sort of hedges your bets against inflation. And last but not least, you can control your own destiny. If you want to paint the walls yellow, you can. If you want a dog, no, you don't have to ask anyone's permission most of the time, unless you live in a very regulated condo community. And so it gives a lot of freedom to people who buy their home instead of renting. You have anything to add there, Rob?
Yeah, I mean, historically, we would have to say that real estate is one of the most consistent investments that one can have. Certainly the last 10 years have been an anomaly to this trend, but historically and moving forward, one would have to think that investing in your home and having that pride of ownership is still a great way to invest your money.
Yeah, absolutely, absolutely. What is amazing is that buying is actually cheaper than renting in all of the 100 largest metro areas by an average of 38%. That's according to Trulia. That was a survey done in 2014, early 2014. So it is not more expensive, actually cheaper by about 38% in most of the bigger metro areas. That's a substantial change, substantial difference.
Certainly is.
Another thing to consider is if you keep renting, rental are going up. I mean, if you see this curve, this is taken from the Census Bureau, and this is the median asking rent from 1988 to 2013. So you see that rentals are actually increasing at a very good clip, and it's something that no one has any control on. It just depends on supply and demand of rental units and renters. So by owning a home, you can get out of this vicious circle of always having your rent increased every year.
Real estate investors, Alan, sorry, real estate investors are making a lot of money off of renters right now, and they're more than happy to keep those folks in there. So it's definitely a great time to take advantage of getting out of that cycle and purchasing your own home.
Absolutely, and you know that the last 5 years, with all the turmoil that we've had in the financial and housing market, it created a whole new market of renters, people who cannot qualify for a mortgage loan or think they cannot qualify for a mortgage loan, and then they go out and rent, which creates more demand, which in turn increases the rental rates because of the demand. So many of the things that have happened in the last 5 years have created a lot of confusion for first-time home buyers. And one of our objectives of being here, Robert and I, to discuss these issues is to just to explain some of the issues and eliminate some of the confusion, because sometimes there's a lot of misinformation. So the three questions that you should be able to answer is, do you know what is happening in the market? Do you know why it is happening in the market? And do you know how to communicate it if you know you need to communicate with your family, friends, with your lender, with your employer, so that you can qualify and become a homeowner? The question that we get asked the most in real estate is how is the market? So we're going to attempt to answer a little bit from the macro level to the Charleston regional level, just to understand what's going on in the marketplace. So let's talk about home prices. What do you think home prices have done in the last few years, Rob?
I have to say that home prices in this market have been on the increase, and I would say in many markets throughout the country that prices have been recovering from the declines of the 2007, 2008, and thereafter.
You're absolutely correct. You can see this map here that shows you by region the year-over-year price change, and obviously some areas of the country have increased faster than others. You see the Pacific region, the mountain region with double-digit growth, and then the South Atlantic region with 8% increase year over year. So that's pretty good. Of course, you know, we had a recession and prices had gone down substantially, so we're recovering from a lower base, but definitely the momentum is there for price increases, and I think that's going to be sustained for the next few years.
Alan, have you seen that the areas that had the greatest declines are also having the greatest recoveries at this point in time?
Absolutely. The biggest price increases are in California, Nevada, Arizona, Florida, Michigan, those areas that were the hardest hit during the recession. So the swings are bigger in those states.
Makes a lot of sense.
So if you see the rate of change of year-over-year prices, that's it was very accelerated in the last year, and then it's kind of leveled off in the last few months. But it's leveled off at a rate of 10 to 12% a year. That means that on average, houses are increasing right now at an average of 1% per month. That's pretty substantial.
Absolutely.
So what's happening in the Charleston area? This is the median sales price for the Charleston area. and it follows a very similar pattern. You can see there, in 2008, 2007, 2008 started decreasing. It hit a low point in 2012, and then it's been in a very steep incline of price appreciation ever since. In the last 12 months, you can see the bar chart above. The median price in the Charleston area has gone up by 9%. Now, this is also different depending on the area of the city that you pick. For example, in Mount Pleasant and Daniel Island, those prices have increased even higher than the average. So this is something that it's very interesting to explore. I mean, pre-bubble houses were appreciating at a rate of 3.6% per year. And during the bubble, 2003 to 2006, they appreciated by 7.9% per year. Of course, during the recession, during the bust, they depreciated by an average of 5.8% per year. But ever since they started to recover, they've been appreciating at 4.7 per year, and it's projected to be sustained until 2017. So an average of 4.7% per year. So it is good that it is not as high as the bubble growth, because that means that it's more sustainable. It's unlikely they will create another bubble and another bust. But it is good in terms that you know that your asset will appreciate for the next foreseeable future.
Yeah, it appears to be getting us back on part of that historical average.
Absolutely, absolutely. In the last 50 years, I think the average appreciation rate for real estate in the U.S. has been about 4% per year. All right, Robert, why don't you talk a little bit about rates and what's going on in the mortgage department?
Absolutely, Alan. I'd be happy to. So this chart here shows you the rates from January 2013 through April 2014, and then projections from Freddie Mac moving forward through the end of 2015. When I first got into business about 10 years ago, we were seeing rates at about mid to high sixes, and after the quote-unquote mortgage meltdown in 2007, 2008, we started to see rates decline rapidly, and the lowest point they ever reached, as you can see on this chart, was at the end of 2013. That's when we were sub 3.5% on 30-year fixed rate money, which was unbelievable and a mark that we will probably never see again. And moving on from there, you can see a steady incline with some peaks and valleys moving through the current date. So we've definitely been on the rise with our interest rates since the end of 2013. Freddie Mac is projecting rates to continue on that path over the next 6 quarters or so, and Freddie Mac is usually a very good indicator of what interest rates will do in the coming months. They have a moving average that they always track, and everyone has their own projections. Fannie Mae is going to be a little different, Mortgage Bankers Association, and in the end, nobody knows exactly what's going to happen to rates. The Fed has had a outlook that they've released recently to the government and to the public that they intend on keeping rates low for the foreseeable future, but as soon as inflation starts to hit and the unemployment rate starts to improve, one would think that they are going to slowly start to increase rates, and the economy should also improve during that time, which will increase interest rates. If there is a large economic disaster or something that no one can predict that happens, then rates will probably stay on the lower side. And as a general rule of thumb, positive news in the economy is going to move rates up, whereas negative news will move rates down. So
right.
Everyone's guess is as good as the next expert. No one knows for sure what will happen.
Okay. So what does it mean for a home buyer?
It makes a huge difference, Alan. I mean, folks in say 10 years ago with a interest rate in the sixes, or in this case 5.7 is the projection in 2015, their monthly payment's drastically different. And not only is their monthly payment different, but that directly affects their purchasing power. So somebody who could afford, say, a $250,000 home, as you can see here, and could afford that payment of $1,250, may not be able to afford the higher payment with the higher interest rate. And this chart here is great. I mean, it gives you a great illustration of how a monthly payment is affected by a change in interest rate. And you can follow the highlighted boxes there that show you a similar payment kind of moving at lower, or excuse me, ascending loan amounts based on an interest rate. So you can see that at about quarter increments, it's a difference of about $5,000 in the loan amount that you qualify for.
So that means that, you know, someone paying $1,022 a month at an interest rate of 5.5% would be able to borrow $180,000, and for the same payment at 4.5%, they'd be able to borrow $200,000. That's a difference in 10% of the purchasing power for just 1% in the rate, right?
Exactly. It makes an enormous difference, and from that first chart we saw, the interest rates have moved up over 1% in just the last 6 months.
So is this a good rate? Is this a bad rate? What do you think historically?
As I said, when I first got in the business, we were in the 6s. I know in the 80s that we were in the teens. So it depends who you talk to. If you talk to somebody who's a first-time home buyer and has only heard of interest rates in the 4s, 5s, and even lower than that, they think that anything above 5 is a high interest rate. You talk to folks of other generations, they think anything under 7, 8% is a great rate. So historically, yes, anything under, say, 8% is going to be considered a good rate. It really depends who you talk to, but it's hard to tell somebody who is used to these low rates that a rate of 5% or 4.5%, as the slide shows, is still a really low rate, even though that is the case.
Yeah, just to illustrate your point, I mean, when I used to live in Australia, we bought our first house. That was in 1990. We were paying 14.5% of our mortgage.
Wow, it's hard to believe.
So this chart shows for the U.S. Look at the difference between what you would have paid in 1983 and you would have paid in 2013 for a $250,000 mortgage.
Yeah, it's amazing how far rates have come down from that time. And so, like we said, I mean, anything that's, in my opinion, anything under 8% is still historically a very good rate. So, even as rates start to go up, which is certainly going to be the case in the coming years, rates will still be in a very good range, and nobody foresees them going back to those 1983 levels anytime soon.
And what is important is the relationship between home prices and interest rates. That's what is called the affordability index. The affordability index right now, it's at a very, very good level for home buyers. The combination of lower prices with lower mortgage rates, it's a winner for all buyers at the moment.
It's a perfect storm, as they say.
Yes. So let's suppose that we get interested in buying a home. So what now? And this is part of the process of buying a home. So what are the things to consider when you're going to buy a home? And this is something that we go through with every first-time home buyer that we meet. We have a buyer consultation, and we go through this process because it's important that they know exactly why, what are they going to do and how it happens. The first recommendation is to hire a realtor. We are professionals who do this for a living. We do this every day, and we sell dozens of properties a year. And so we're very used to the process, and we know the pitfalls and what to avoid. Some people think that by skipping an intermediary, they're going to save some money and they can get in hot water in no time. Not only there are legal implications, there are economic implications, and there's also a big factor that it is if you don't have a good experience as your first experience, if you get burned down, if you get burned out, you might not want to take that step again because you had a bad experience, and that's not good. It should be a fun experience. It should be something exciting, something you look forward to, So it is better to hire someone who knows how things work and can hold you by the hand and walk you through the process so that nothing bad happens to you. Also, it's very important that the realtor will represent your best interests and act as a buffer in the negotiating so that if things get a little bit emotional, the realtors can detach a little bit the negotiation from the principals, and that sometimes becomes a very important issue. And here's something that Dave Ramsey, the financial guru, says: when getting help with money, with insurance, real estate, or investments, you should always look for someone with the heart of a teacher and not the heart of a salesman. That is, in our view, very important. We are low pressure salespeople, and we don't like to push people. We like to make people understand exactly what they're getting into and understand all the process. So that they ask the right questions and give them all the right information to make the right decisions in their own time.
That's exactly right, Alan. I think there's nothing more important than empowering your clients with the ability to make an educated decision.
Exactly, exactly. One of the things that is important to know that sometimes people forget about is that in South Carolina, you can have buyer representation, you can have seller representation, or you can have a dual or designated agency. Most of the time, people that come from other states sometimes are not familiar with the buyer representation. If you call a listing agent, that listing agent by law needs to represent the best interest of the seller. So if they ask, if a buyer comes in and likes the property and likes to make an offer, that listing agent cannot help the buyer negotiate against their principal, the seller. In South Carolina, buyers can get a buyer's agent to represent them at no cost to them because the commission is paid for by the seller through the MLS and the commission that the listing agent shares via the MLS. Another very important issue is when you go to new construction sites, to builders' offices, that person who's at the builder's office represents the builder, the seller. And of course, they say they can represent you, but in reality, they're being paid by the builder, and that's who their first allegiance is to. And it is not true that if you don't have a buyer's agent, you can get a better deal, because especially in new construction, those commissions are always pre-built in the list prices, so they're not going to give you a better deal just because you go unrepresented. Have you come across these issues, Robert?
I absolutely have. I can't tell you how many first-time home buyers that I have been working with who decide to use an agent who's representing the seller and not realizing what they are basically foregoing. I mean, having somebody to negotiate for you, to look out for your best interest, really makes a huge difference in not only the experience, but making sure that you get the best deal that you possibly can on a transaction.
Then once you pick your agent, whoever you like and trust, then the next step is to find the money. Tell us about the money, Robert.
I'd be happy to, Alan, and I'll tell you guys, things have changed drastically. Before the mortgage meltdown, all one would need is a driver's license and a pulse to get a loan. And things have swung drastically in the other direction, where now the qualification process has become very strenuous and a lot more difficult. But there are ways to get yourself in a position to not have as many difficulties getting qualified, and one is establishing a relationship early with a lender that you can trust that can guide you through the process. The main qualifying criteria that any underwriter or lender is going to look at are what I like to call the 4 C's. This is the capacity, capital, credit, and collateral. Capacity is basically the ability to repay a mortgage based on your income and work history. So we're going to take a look at your most recent 2-year work history, look for some consistency there, and then also look to see how you're compensated. Are you paid hourly? Are you paid on a salary? Or do you receive commissions and bonuses? And based on what the answer to that is, it certainly affects what you can qualify for. And we use that to come up with what's called a debt-to-income ratio. So we would basically take a look at your credit, and that's another C, and see how much outstanding debt you currently have. To that, add a proposed mortgage payment, and then take that as a ratio of your current income. And this plays another large factor in the qualifying process. Credit also shows us the confidence, or gives the bank confidence in your ability or intention to fulfill your financial obligations. So everyone will get three, in general, will get 3 credit scores. And we use the middle of the 3 scores. And that score is directly representative of how well you've handled your credit in the past. One of the other C's is capital. And so this would be your assets. So money that you have to make for a down payment, money for reserves. All of these are very important factors in the qualification process.
So if I don't have a ton of money, I cannot qualify, or what's the deal?
No, that's not the case at all. There's actually a number of programs now that do not require a down payment or a very low down payment. And I'm going to run through those loan programs here in a second. But the final C is collateral, and that is the property. So we need to make sure you have acceptable property as security for the loan or obligation. And this would be where the appraisal comes in. This would be the inspection. And this is where Alan can really, and his team, guide you to make sure that you're getting a property that is going to be acceptable by the lender, but also be a great property for you as well. And to Alan's point, there are a number of loan programs available today. A conventional loan is a loan that's really for people who are strong in all of their C's. So they have strong income, strong assets, strong credit. And if you're making a nice down payment and good credit, a conventional loan is typically the best loan for that person. The 3 loans here on the left, FHA, VA, and USDA, are all government-backed loans. An FHA loan is a great product for a first-time home buyer and people that have less than perfect credit. You're still going to get a very favorable interest rate, even if your credit's not perfect, and the minimum down payment on that is 3.5%. It also allows for the seller to contribute a large amount towards the closing costs, which can be helpful for folks that don't have a lot of money in their pocket. A VA loan is a loan that's specifically for military veterans, active duty, and reservists. And this is a wonderful loan for all our military people. It does not require a down payment. So it allows you to purchase a home with no money out of pocket, and is a great product for anyone who's eligible. And the other government loan is the USDA loan. These loans don't come up quite as often in this area, but in certain parts of the country or other parts of South Carolina, they're prevalent. And it's a loan specifically for people who can find a home that is in a rural area. There are some income qualifications on this, but it's also there's no down payment, so 100% financing and no monthly mortgage insurance, so it's really a favorable loan. And the final loan we have listed here is a jumbo loan. And this is for folks who are purchasing a home over what we call the conforming loan limit of $417,000. This doesn't come up very often for first-time home buyers, but it is a loan that is available and for folks that are purchasing larger properties.
Okay, so if I'm a first-time home buyer, I come to you, I give you my information, I get qualified for a loan. What happens next?
So once we review everything, I mean, the first thing I like to do is review a person's entire financial situation, but also review their credit. I can't tell you guys how important it is to really pay attention to your credit yourself and to have somebody look at it with you, an expert. Having a credit score of 640 versus 620 or 700 versus 680, just a few points can make a huge difference in the rate that you qualify for and the long-term price of the loan. And the other piece of that, Alan, is once we have everyone ready to go, is a pre-approval letter. I can't tell you how many people have come to me with a home that they have fallen in love with and have to purchase, but are disappointed to find out that they just can't qualify to purchase that home. So I know you see that all the time too. It's just so
Well,
vital.
we really don't want to show homes to anyone who doesn't want to go through the trouble of getting pre-approved because it's frustrating for everyone. They find the perfect home, they fall in love with the home, they negotiate a great deal only to find out that they can't qualify for the loan. So it's frustrating for everyone. That's not a good thing.
Yeah, and I can't stress that point enough. And Alan is correct. And any of the clients that I'm fortunate to work with that are also Alan's clients are always coming at the right time, but there are people that don't. So, everyone, please pay close attention to that and make sure that you are fully pre-approved before you are ready to, go look at
And and,
homes.
and before we go into the next slide, pre-approvals come in different flavors, right?
Yeah, that's exactly right. So if somebody gives me their initial application and asks me to run a credit report, um, I can take a look at that and give them what's called a pre-qualification. Pre-qualification really holds no weight. It's not something I can really write a letter on to provide with an offer. A pre-approval is not in place until I have the actual paperwork to back up everything that's listed on the application. Everyone's income's a little different, or their assets may not show up how they're mentioned on their application, so we have to verify everything to make sure that we are good to go. And once you have that pre-approval, then I can write a letter, and then you can provide that with your offer, and it holds a lot more weight.
Yeah, as a listing agent, I would never give any credibility to a pre-qualification letter because the loan underwriter has not seen all the real paperwork for the borrower. They haven't seen their tax returns, they haven't seen their pay stubs, they haven't verified their employment. So basically, they're going on faith of whatever the person tells them. But rest assured that once the loan is in processing, they will check everything. They will dot every I and cross every T, and if they find something they didn't like, they will not approve the loan. So you really are not doing yourself a good service unless you get a pre-approval letter. Now that brings me to a good point, Robert. That is, people that get pre-qualified online. What do you think of that?
Well, it just depends. I mean, there are lenders, online lenders out there that do a great business and have a great model in place. In general, I would say that people are much better off to actually have someone local, someone that can actually serve as a consultant that they can talk to or meet in person and actually walk through the whole process with them, especially for first-time home buyers.
Absolutely. I agree. We've had many instances where, we're about to close a loan and, the lender is on the other side of the country. There's 3 hours difference and they've either not come to work yet or they're closed for the day, and then the transaction stops because there's no one on the other side that can actually provide service.
Right, and that's something we really take pride in, is that consultative service. And we've built a team of great people that make the process as smooth as it can possibly be, considering the requirements that are in place these days. And it's just so important to have someone that you can count on, somebody that you can go see, and someone that your realtor can count on too, to make sure that things are done correctly.
Okay, so I get pre-approved and I go out shopping for a home. What is this? What are these 10 commandments?
Alan, these are things that a borrower does not want to do once they've started the loan qualification process. These are things that can certainly kill a deal or keep somebody from getting qualified by doing any one of these things. Now, I'll quickly run through them. One, do not change jobs, become self-employed, or quit your job. This one does not come up often, but let's say that you've been in a salaried position for a number of years. You've been thinking about becoming self-employed or moving out on your own, and say it's a great opportunity and something that's going to bear fruit in the long term. Well, the problem with this is that anytime you're self-employed, commission, bonus, anything that is not guaranteed, you have to have a 2-year history. So all of a sudden, even if you're going to make more money by making that change, if you are not guaranteed that money, then we cannot use that income, and all of a sudden, you can't qualify for a loan. Number 2, buy a car, truck, or van. This does come up on a regular basis. People A lot of times have the wherewithal to come to us and ask if it's something that they can do first, but other people don't. They'll go out and buy a car, take on a lease, and what this does is affects your purchasing power. It limits it because you have it increases your debt to income ratio and you can afford less. So this is a huge no-no. Use charge cards excessively or let your accounts fall behind. Running up your credit card debt is a problem. You have a limit on your card. Let's say it's $1,000. If you're almost maxed out on that card, not only is that going to negatively affect your credit score, but it's also going to hurt, again, your debt-to-income ratio and how much you qualify for. So it's very important that you keep those balances low, and also on your accounts, making those payments on time every month is vital. Just missing one can drastically reduce your credit score. Spend money that you have set aside for closing. Even if you have money set aside for closing that you can prove when you apply for the loan, if it's not there to the penny or you don't have enough to cover the closing costs, because it does get rechecked at the end, then you're out of luck and you cannot close that loan. Omit debts and liabilities from your loan application. Most of your debts and liabilities will show up on your credit report, but it's always safer to make sure that if something's not on there that you disclose that, because it will come up down the road and could create an issue. Buy furniture on credit. Again, this will limit your purchasing power. Originate any inquiries into your credit. On this one, you don't want to apply for new credit cards, because basically it raises a red flag to the lenders because they see you wanting to take out more credit, and that as soon as you have more credit, that's more risk. And so they view that negatively. Make large deposits without first checking with your loan officer. This may be the biggest problem that we have come up on a regular basis. Somebody may have cash, what we call mattress money. They may have gold coins that they can't document. They may have a friend that owes them thousands of dollars, and if they take that money and just dump it into their account and plan on using that and cannot source it, then in most cases we cannot use that. Anything that you put into your account that's a large deposit, we need to be able to easily source. And if you cannot easily source it, the only other way to make that work would be if it were a gift from a family member, to be able to document it that way. But that is probably the biggest one of these that I have come up on a regular basis that can.
Yeah, me too. I've come up with clients that have done that, and it's been a problem. I mean, they require all kinds of documentation, and then if your uncle gave it to you, they want to see the bank account for your uncle and where did he get the money from, and it's a problem.
Exactly, and I guess the biggest thing to say on that, Alan, is if you cannot create a paper trail, so a bill of sale, if you had gold coins or something of that nature, then it's not going to work. And cash is the most difficult thing to deal with. So
right. So if you have mattress money and you're going to use it for the purchase, deposit it in your bank account before you apply for the loan.
Exactly, and just a rule of thumb for everyone out there is this is what's called seasoning your money. If you put any money like this into your account 60 days beforehand, then it's considered seasoned, because we will collect 2 months of bank statements. And if we don't see it going into the account because we're taking a snapshot of your financial picture, you do not have to source it. So it's very important to season any money like that that's not easily sourced. Number 9, change bank accounts. This isn't one we see come up often, but it's better to just not do anything like this until after closing, and then co-sign on a loan for anyone. And this is one that I do see come up often. Folks, parents especially, will co-sign with their children. The children will miss payments or go into default, and the parents are equally liable and affected by this.
Right, okay. Well, here the slide came off a little bit. It's not the home purchasing. It's the home purchasing. So this is kind of the flow chart for the complete process of buying a home from A to Z. We went through the first ones. You hire a realtor, analyze your needs. We do a buyer consultation, obtain the loan pre-approval. Then after you have the loan pre-approval, we can actually go and select properties based on your criteria. And then we can go see those properties. If you like one, we write an offer to purchase. which comes accompanied by an earnest money check. We negotiate and counteroffer until both parties meet the minds. And then we have a signed contract, what we call a ratified contract. At that point, the buyers need to perform their due diligence, which includes perform inspections, title search, select a closing attorney, negotiate repairs, order survey, obtain insurance. All those things need to be done from contract to closing. The buyer also needs to complete a formal mortgage application with the lender. The lender will order credit reports, the appraisal, and go to underwriting until everything is fine and they approve the loan. Once all the inspections and the due diligence is finished, the contingencies are removed and we can close on the property at the attorney's office. South Carolina is an attorney state, so we do need an attorney to close the transaction. And once that you close on transaction, normally you take possession of your new home. Anything to add here, Rob?
Nope, you did a great job.
Okay. When we go around with buyers looking for a home, it can get confusing because people, especially people that don't know the area, they start comparing one house in one area with another house in another area, and they can get really confused. So one of the approaches that we use that has been very effective for our buyer clients is to use the helicopter approach. Come up from 20,000 feet above the clouds and pick the areas you like the most based on your big rocks, on your big criteria. For example, commute time, distance to the airport, schools, distance to the beach, etc. Those are the big rocks. Once you select the area, come down in your helicopter under the clouds, and within the areas that you picked, pick the neighborhoods you like. And then, and only then, start looking at the homes and comparing homes against each other, because you know that if you find a home that you like, all the other things fall into place. You know, it's in the right neighborhood, it's in the right area, and you can focus your search on selecting the right home for you. So this is a process that we've developed over the years, and it's worked very well for our buyer clients. Once you select the property you want to make an offer, then we do what we call a CMA. It's a comparable market analysis where we look at similar homes or similar properties that were sold recently in that area, and to give us an idea that you're paying the right price for the property. You're not overpaying. Now, if you're underpaying, that's great, but not overpaying. We also have to keep an eye on what Robert mentioned before, the appraisal. So even if you're willing to pay more than recent comparables have sold for in the area, you may have a problem when the appraiser comes in and looks at the comparables and says, look, you know, based on what I see, your home is not worth what you're willing to pay for. And that's something that we need to keep an eye on. Then we also negotiate terms like when do we want to close? Do we want the seller to pay for closing costs? What are the things, what are the concessions we're asking for? What appliances stay with the home, etc. And those are, you know, the negotiations that can take some time, back and forth negotiations until all the parties agree to all the terms and all the negotiations are signed and sealed and delivered. And then we have a ratified contract. Again, once you have the ratified contract, you need to submit a formal loan application with that contract to the lender that you choose, and you do have to do your due diligence or the repairs and satisfaction. The new contract has two versions. The due diligence just says, for this period of time, I am doing my due diligence and I can get out of this contract for any reason whatsoever by paying a fee. I don't need to give any reasons. Within that time constraint, if I pay my fee, I can get out for whatever reason I choose. The other option is the repairs and satisfaction, where you do your inspections, you submit a list of repairs. If the seller says, yes, we'll do those repairs, then that contingency is removed and you proceed to closing. If the seller says no and you're not able to negotiate the repairs, then you can get out of the contract with costs and get your earnest money back. Survey and elevation certificate. A survey is something that normally we recommend when there's an older property where there is the possibility that maybe the neighbors move the fence, they're encroaching on each other's property, or we don't know exactly where the property is. And then an elevation certificate is something that has become extremely important given the importance, especially in the Charleston area, of flood insurance. And FEMA has gone to more of a market-based rate. There was a big problem last year with flood insurance, which seems to have subsided a little bit, at least delayed a little bit. But if you are required to have flood insurance, if you're in a flood-prone area, the lender will require that you hold flood insurance, and you will need an elevation certificate to get that flood insurance. Once you select also the closing attorney, they will do a title search. They will look back 40 years to make sure that the title didn't have any problems or liens that were not satisfied, that you don't have any problems. So you can get what they call title insurance, protecting your equity during the time that you hold that property. And then you have to shop for insurance. Insurance, we have three kinds of insurance. You have hazard or homeowners insurance. If you're in a certain area of the city, namely east of Highway 17, you might need to shop for separate coverage for wind and hail. And then you have your flood insurance, which is normally purchased from FEMA directly.
And I'm going to make a plug for you here, Alan. Guys, I just can't tell you how important it is to have a realtor that you can count on during that due diligence period. I mean, when those inspections come in and repairs need to be made, you need someone on your side to help make sure that you get those things taken care of. Sure. And I've seen it time and time again with Alan and his clients. He's always willing to go to bat. And if it doesn't make sense and they can't get those repairs done and it's not in the borrower's or buyer's best interest, then Alan's going to let you know that and make sure that you make the right decision.
Absolutely, and then buying a home is not rocket science. It's not overly complicated. But if you skip one of the steps, or if you forget to do something, you might pay dearly for that mistake.
Right, and then you also have the centers of influence that are very important when you're working with a realtor and a lender. I mean, Alan and I both know great insurance people and can make sure that you get a great inspector and folks that will really be looking out for your best interests.
Right. That's a very good point, and we work in this every day, and we know people who do the right thing by our clients, and we recommend those people. So that's important because sometimes people like to use the cheapest providers. They're not always the best providers, but if they're cheap and they're good, I'm all for it. All right. Well, once we decide to close and everything's done and properly, the lender sends what they call a loan package to the closing attorney. The closing attorney does produce what they call a HUD statement or a closing statement. It details the financial transaction. And you have to select as a buyer how you want the deed. There's two versions, the joint tenants with right of survivorship or the tenants in common. Joint tenants with right of survivorship is normally the way that married couples take deeds in, and if one of the the husband or the wife passes on, the house is automatically deeded in the other person's name. It doesn't need to go through probate. With tenants in common, the portion of the property that belongs to that person needs to go to probate, and then that portion is distributed according to their will. So sometimes it can take a while to be distributed. Also, the attorney will ask you to sign a mortgage and a note. The note basically details the loan that you're getting from the lender. So it states the amount, the interest rate, when the payments are due, etc., when they're late, what penalties they have if they're late, etc. The mortgage is the collateral. Is where you tell the bank that you put the home as collateral for your note. And basically the bank is saying, if you pay, you stay. If you don't, you won't. So if you stop paying, and they will initiate foreclosure proceedings and will take the house away from you. And then they will make you sign, it seems like dozens of disclosures. How many signatures do you think a buyer will have to do at a closing?
It really depends on the loan type. I would say an FHA loan, you're probably looking at about 70 to 80. And I'll tell you, if there's uh, you know, a different type of loan, it would be less, but that's going to be the one that has the most signatures.
Yeah, the easiest ones are the cash deals.
Yeah.
They're a lot quicker, but those are few and far in between. Most people need a loan, and yeah, it'll be between 50 and 100 signatures depending on if it's one or two mortgages. So once that closing happens, the keys exchange hands, and the home is yours. And that's, in a nutshell, the process of buying a home in South Carolina. Of course, there's a lot more detail than we can give you in this webinar. But if you have any questions, here it's our contact information. I'm a realtor, Alan, I'm a realtor, and Robert is the mortgage specialist. And we're here to answer your questions.
Thank you so much, Alan.
Okay, well, thank you very much for attending this webinar. If you have any questions, make sure to type them into the chat box. And we will record this and put it on YouTube and try to answer any questions that we have. Also, you can email us or give us a call. And thanks for attending, and we'll look forward to seeing you in our next webinar. Thank you, Robert.
Thank you.